Good morning, good afternoon. Think we're letting people in from the waiting room. We got a good group already coming in. I usually ask where people are joining from, but sometimes that's a little boring. What'd you have for breakfast today? Drop it in the chat. No, nobody? Nobody eats? Well, as you might notice, I am not Luke. Ooh, acai bowl, banana fruit. This is healthy. Coffee. Same, Karen. Someone said poppy seed. Yeah, poppy seed muffin. That sounds delicious. Intermittent fasting. Won't eat till 2. Good for you, Anthony. I can't do that. I get too hangry in the morning. Hot chocolate. Delicious. I like this. This is inspiring. Tamara, yes, there will be a recording and we'll send out the materials after. Great. Well, thank you for the participation. I might need second breakfast, Hobbit style, after reading all these comments. I am not Luke. You got invited to a webinar with Luke. I'm covering today. So we'll have a great time. Hopefully I can live up to the Luke vibe. If you've seen one of his webinars, he brings some good energy. So we'll get going. Thank you guys for the participation. Keep it coming. If you've got questions throughout the webinar, we're going to do just a short presentation, some high-level education on S Corps, and then we're going to pivot over to live Q&A. So please use the Q&A feature within Zoom instead of the chat. We will be monitoring the Q&A section for that portion of the webinar. All right, we're going to dive in. We've got a good group. So this session, we're going to talk about maximizing your tax savings through an S Corp. High level, these first 4 bullet points, we're not going to spend too much time. We're going to breeze through it so that we have time for all of your questions. S Corp explained what it is, how it works, how to switch to S Corp. What else is advantageous when you, besides tax savings, what to consider, which structure is the best for you. And then we'll turn it over to the group for some good Q&A. This webinar is for educational purposes only. Nothing contained in this nothing contained in this or in any related webinar should be viewed as legal or tax advice. Always consider consulting a professional if you need legal or tax advice in operating your freelance business. So real quick, Collective, who are we? We're an all-in-one platform designed specifically for solopreneurs and self-employed individuals. So we do everything that you need to stay compliant, capture tax savings under the S Corp structure. Diana, I just glanced at your question. I'm based in San Francisco, so it's morning, almost time for second breakfast. So the S Corp explained what it is and how it works. So if you've seen any of Collective's content, you might have, this could be a repeat of some of the educational pieces that you've seen. What is an S Corp? So it starts out as a legal structure. It actually forms in two phases. First, you establish a legal business entity at the state level. So a couple legal structures could be an LLC, a legal corporation, or a professional LLC if you've got like a state issued professional license. A legal entity or a legal status is what's formed at your resident state. It's what gives you an EIN, a legal business name. It creates a layer of liability protection. So it's the foundation of forming a business. What's layered on is how you're taxed. So the tax status is something separate, and that's where the S Corp comes into play. There's 2 tax statuses that we're going to cover in this session. One is sole proprietorship. So if you formed a single member LLC or you haven't formed anything, you're reporting your taxes as a sole proprietor, which means everything gets lumped into your personal tax return. Pretty simple for filing. The alternative is what Collective specializes in, and that's the S Corp tax status. And so how do we get to S Corp? It starts as a legal entity first, either an LLC legal corporation, professional LLC. And then you add a tax election, S Corp, to gain S Corp tax status. So it happens in 2 phases. Now, how does it work? Why is it so advantageous? Why are people choosing to elect S Corp status? It has to do with the way you pay taxes. So if you're a single member LLC or sole proprietor, you pay 2 different types of taxes. One is income tax. Everybody pays income tax if you have taxable income. This is what gets reported on your personal return. It could be, you file single, married filing joint, at a household. This is what's due April 15th. Income tax is calculated based off of your total household income, your filing status. It's assessed at the federal level, and then it could also be assessed at the state level. What's unique about being a solopreneur is you also have this layer of self-employment tax, which is made up of 2 different taxes, Medicare, which is 2.5 or 2.9%, and Social Security tax is the bulk. It's 12.4%, which comes to this 15.3% self-employment tax that you'd pay in addition to your income tax. So what's happening here as a solopreneur, you're paying 2 buckets of tax: income tax, federal and state, and self-employment tax. Now, how does switching to an S Corp change your self-employment tax burden? When you elect the S Corp status, it changes the way you receive your compensation, and it changes how much of that compensation is subject to which taxes. So what happens? First, there's no self-employment tax on your S Corp profits. What does this mean? When you're a sole proprietor, you pay income tax and self-employment tax on your entire business profit. So you've got all the layers of tax on all your income. When you switch to S Corp, you're required to pay yourself a salary. And then only the salary is subject to the self-employment tax instead of the entire profit. So if we go through this list, what changes? There's no self-employment tax on your S Corp profit. It's only the wage. When you elect S Corp status, you become both the owner of the business and your own employee. And that's because you're required to pay yourself a salary. And that's the means to pay into this self-employment tax. To reiterate, only the salary portion is subject to the self-employment tax, Social Security, and Medicare, rather than your entire profit. And the bummer, you still pay income tax on everything, whether you distribute it out as an owner draw or not. It's still income earned within the year. So you'll always pay income tax on your entire profit. The S Corp just allows you to carve out a smaller portion to pay the self-employment tax. Now here's a walkthrough, an example of a solopreneur who's earned $160,000 of business profit. So what's profit, real quick? Revenue is what you're billing your clients. Expenses or deductions or write-offs, that's all the eligible business deductions. So marketing, invoicing tools, your collective subscription. Those are all deductions that help you arrive at business profit. Profit is what you're ultimately taxed on, whether you're sole proprietor, single member LLC, or S Corp. The profit is what you pay tax on. So this individual's earned $160,000 of profit. On this left column, they're still structured as a sole proprietor, which means everything's reported on the personal tax return. And under this reporting structure, the entire 160 of profit is not only subject to income tax, but it's entirely subject to this 15.3% self-employment, which is yielding this close to $25,000. As an alternative, this person could elect S Corp status. And once they do that, they're required to pay themselves a wage. And so in this example, the wage is $60,000, which means the remaining $100,000 can be taken as an owner distribution. So you still have your total cash flow. That doesn't mean you suddenly learn to live off of 60 grand when you're used to earning 160. You still have your total compensation, you just receive it in 2 buckets. So now under this structure, the owner is taking a salary of $60,000, and now only that $60,000 is subject to the self-employment tax instead of the 160. So now we've got self-employment tax of $9,000 compared to $25,000, which is yielding a savings of about $15,000. That's just self-employment tax that you don't pay. That was a lot. So I know there are a lot of questions happening in the webinar chat. I see them coming through. If you can, please copy and paste them into the Q&A section so that I can get to them when we pivot over to that part of the session. How much, real quick, how much are you paying? So this is a question that comes up often. I'll explain it while we have this slide up. What happens to the $100,000 on the S Corp side? The entire 160, your business profit, will always be subject to income tax. It's just that now we're carving out a smaller portion to pay self-employment tax. So the owner wage, the 60,000, you'll pay income tax and self-employment tax. The remaining 100,000 is only subject to income tax. So that 160 is still yours to use however you need to for personal expenses. It's just split into two buckets. One portion you pay all three layers of tax, federal, state, income tax, plus self-employment. The remainder is only subject to income tax. Additional perks beyond tax savings with an S Corp. So the big thing, I don't have this on a slide, but the big thing with S Corp, there's a common misconception that it unlocks all these new tax deductions. It doesn't. If you're set up as a sole proprietor or a single member LLC, you report your business activity on the Schedule C that's on your personal return. And it's all the same write-offs. All the same deductions are allowed whether you report on the Schedule C or an S Corp tax return. The IRS just says that an expense needs to be considered ordinary and necessary to generate revenue. So in either instance, like your marketing expense, your invoicing tool, mileage, like all of that remains deductible. Nothing new is unlocked with the S Corp besides the ability to control self-employment tax. Now, additional perks beyond tax savings that business owners love with Collective. I'm just going to highlight a couple quick things that come with the Collective membership that make Collective unique, in addition to bundling together all the S Corp compliance. Members who join Collective are added to the Collective community, and this is something that's relatively new to Collective. But once you join, you have access to a calendar of weekly events. There's a job board, so if you're looking for a photographer or a designer or an IT consultant, anybody who's participating in the community can post their needs and interact with each other on the job board. Perks and rewards. We do a lot of, I'm sorry, I'm blanking on the word, a lot of prizes, perks and rewards. We'll do contests, drawings if you refer out. I think we just did like an iPad giveaway. So there's a lot of engagement that's not just like tax stuff that's happening within your Collective dashboard. There's also an Ask Your Community forum. So maybe it's kind of like a Reddit board, but it's all Collective members, all self-employed, all solopreneurs who are sharing or feeding their experience within the community. And I mentioned this briefly, referral. We have a great referral program. So if you know other solopreneurs in your network, Collective members sign up, you get a referral code. You can get $600 cash commissions for everybody who signs up. It's a great way to get your membership paid for. If you're not a member, Collective is super niche. Like if S Corp's not the right fit for you, but you still want to refer, we've also got an affiliate program. So a couple perks that a lot of folks that we meet with like to take advantage of with your Collective membership. And real quick, we're going to switch over to a quick poll. We'd love your participation, and my colleague Sarah is going to pull it up. Would you want to meet with a Collective advisor after the webinar to see how much your business could save with an S Corp? It's a super quick yes or no. So I'm going to leave this up for a minute. And while we do that, I'm going to scroll through the chat and make sure S Corp in all states. Yes, most states will recognize, I think all states recognize the S Corp election. You may have to separately elect with your state. Let's see. There are some great questions in the chat. So again, if you haven't moved it over to the Q&A, would ask you to do that. And there's 27 questions in the Q&A. We're going to wrap up the poll here in a second. Jake, I just saw your question in the chat. I'm going to refer to the Q&A section. So if you want to copy and paste it in there, I'll make sure we get to it. All right, Sarah, I think we can wrap up the poll. Thank you for the engagement and the participation. Real quick, before we end on the talking portion of this session, when do you know when S Corp's right for you? Real quick, we're just going to cover LLC versus S Corp. So which one suits your business? The answer isn't one size fits all. If you're joining this webinar, you might be intrigued by Collective. You may want to join. We may not be the right fit. So we really want to make sure that you're getting the education to decide what structure is the best for you. S Corp doesn't make sense for everybody. So LLC is best for people who are exploring a freelance or side hustle. Maybe you're still working a full-time gig, you've got high earning salary, the business on the self-employment side is new, it's less than 60,000 a profit. It may be best to stay in LLC. Why? The S Corp triggers a lot of additional compliance, which is costly. And so really when people are considering switching to S Corp, what they're looking for is a savings opportunity. And if you're on, the LLC side of this slide deck, you may not save. And so if savings are your objective, if you're new to your business, not a lot of earnings, less than 60,000 a profit, you've got a high earning full-time role, the S Corp may not save you money, especially when you consider the cost of compliance. Alternatively, the S Corp could be best for somebody who wants to maximize retirement savings. So the S Corp, you can optimize a solo 401k. You can now do employee contributions in addition to employer contributions. If your business profit goes up, then you're unlocking more opportunity to control your self-employment tax. And when the profit goes up, your savings potential is going to be more than the cost of compliance. So that's why this $60,000 threshold exists. It's not a rule with the IRS. It's just at what point where your savings exceed the cost to do the extra work. And then if you don't have additional wages over 100,000. The reason this is an arbitrary threshold, it's not a rule, again, with the IRS. The reason we have to consider if you're earning additional wages is it has to do with the way the IRS assesses the Social Security tax. And there's a wage base to calculate this 12% Social Security tax. The higher your wage, the less ability you have to control the Social Security, which lessens the savings opportunity. If you're interested in scheduling a call with a Collective business advisor, they're going to ask you all these questions to decide if your situation, warrants staying in LLC, forming an LLC, or electing S Corp status. So the compliance, the cost of compliance, why is it so expensive? Why do you need to consider your profit, how much your salary is? When you elect S Corp status, it triggers a more complicated tax profile. Something you could totally tackle yourself. You would have to piece together a couple different services to get to what Collective bundles together. You've got to consider a separate business tax return filing, forming the initial LLC if you don't have one already. More robust bookkeeping is required. You need both profit and loss and balance sheet to be reported on your S Corp tax return. So like the Excel spreadsheet or the Google Doc won't really cut it when you have an S Corp. So you want bookkeeping. So maybe that's a QuickBooks subscription plus a freelance bookkeeper. And then the big one is what actually prompted me to sign my dad up for Collective. The payroll component is really challenging. You truly have to run payroll to pay yourself a reasonable salary. And so this requires a payroll software. It's going to generate pay stubs, automatically remit all the withholdings and the Social Security and Medicare to the IRS. There's also quarterly and annual payroll tax returns that are due when you run payroll. And so, payroll software is going to automate all of this. So by yourself, you can DIY it, bundle it together, maybe save a couple bucks, but maybe you're spending more time versus with collective one login. All of these pieces are put together for one fee. And again, to reiterate, if the S Corp is the right fit for you, we would handle, everything from forming the initial business to all the operating components, monthly bookkeeping, filing that business tax return, running payroll, and then ongoing support with an accountant advisor. Okay, and now we're going to pivot. I see, let's see, how many questions do we have in here? 43 questions. And a lot of great conversation happening in the chat. One more time, if you have put a question in the chat, please put it over in the Q&A, and we will make sure we get to it. I'm going to dive in. If you're interested in scheduling a call, you can scan this QR code. For joining this webinar, we've got a special promo code, April on Us. It's going to be a free month of collective. It is a first week or week of webinar discount. So it's going to expire at the end of the week. So if you're interested in scheduling a call, you can do so while we're, going through these questions. Melinda with an early question. Thank you. At what point do I need to set it up if I'm brand new and haven't made any money? So two parts to setting up an S Corp, right? It's going to start as that legal entity, the LLC. If you have not done the LLC, what I would consider before doing that is, have you proven, how committed are you to the self-employed business? Because there's nothing wrong with operating as a sole proprietor. If it's very new, like you're testing the theory, you don't even know if you like self-employment, it's okay to stay a sole proprietor, meaning you don't set anything up. You still want to report all your business income and expenses on that Schedule C on your personal return next year, but you're not required to set up an LLC. If it's something that you're committed to, like you've got people organically sending you leads, you're setting yourself up to quit the corporate job, then I would say now's a good time to set up the LLC. What that will do is lay the foundation for a future S Corp election. So you don't need to do all of the setup in one motion. You can start as an LLC and then opt for the S Corp election at a later date. The advantage of setting up the LLC sooner than later is that's the soonest that you can elect S Corp status. So for example, if you want to, if 2025 is going to be your year for self-employment and you don't have an LLC and you set one up today, April 9th, would be the earliest you could elect S Corp status, meaning what happened from January to now would get reported as a sole proprietor, and then the rest of the year would be under the S Corp. LY, can you please shed light on 401k for single owner S Corp, for example, timing, impact on savings, and how does the impact quarterly estimated tax payment? So usually single owned S Corp, we see a solo 401k. It's a 401k that's built specifically for a single owned and operated S Corp. 401k is unique to other retirement plans like SEP or traditional IRA, Roth IRA. One, because it has higher contribution limits. So if you want to just max out retirement every year, I think IRA and Roth are, 6,500, 7,500, maybe with the catch-up contribution. So it's a lower limit versus up to, I think 2025 is 73,000 for a solo 401k. What's unique about making contributions to a 401k under an S Corp that you own is who's contributing. You contribute wearing two hats. One is you as the employee. The IRS says the employee, whether you're an S Corp or an employee of another company, you can contribute up to 23,000 flat out. So if you're an employee, 23,000 you can put into retirement as your own contribution. That contribution reduces your taxable wage. So it's a pre-tax contribution. You pay the tax when it comes out and get a deduction for it the year you contribute. So you've got an employee contribution, 23,000. And then your S Corp can make a matching contribution of up to 20% of whatever your S Corp salary is. And between the two, it cannot exceed 73,000. Whatever the S Corp contributes to retirement is just a flat out deduction that reduces the profit you're taxed on. So in either instance, employee, employer contribution, it's reducing your taxable income in the year you contribute. And then again, you'll take the tax bill hit when you withdraw. Impact on quarterly estimated tax payments. You want to just consider the reduction of your profit when, if you're going to make a 401k contribution, and you consider your profit being lowered when you do your estimated tax calculation. Can you please discuss QBI applicable this year for S Corps? So QBI, Qualified Business Income Deduction. This is the 20% deduction that was new to the tax code in 2017. When you switch to S Corp, you're still allowed a QBI deduction. It's just the way that it's calculated is a little bit different. I may have to get some more detailed responses for you on this because it's been a while since I've touched on it in depth. But high level, your business profit, one, you have to determine, is your business considered a qualified business to take this 20% deduction? The IRS has coded for the purposes of QBI two different categories of income. One is qualified business income. One's called a specified service business income. And in either instance, if you fall under one category, the SSTB, specified service business, trader business, there are certain thresholds that you have to be below for you to be eligible for a QBI deduction. If your business is considered a qualified business, those thresholds may not apply. So high level QBI, let's assume that your business is considered qualified. It would be in general 20% on that business profit, but there are some limitations, like it may be based on your wage, or if you have, depreciation for your business, some of those factors could limit the QBI deduction. But high level, when you switch to S Corp versus single member LLC, QBI still does exist and you're still generally eligible. Wayne, yes, there will be a recording. John, for kids payroll, let's see, I'm going to read this first. For kids payroll, to not file W-2 and do payroll in the LLC as the parents, but also an aunt, is that okay? Don't have to process pay of the third member is also family. Okay, so this question is in general about paying relatives. Super high level, the IRS has a lot of rules about employing underage relatives and family members. So you want to consider, if you're going to put them on salary, document a business purpose. They have to be paid a fair and reasonable wage compared to the market. And then if you're running payroll, like they're on salary, you want to still run them through a payroll process, which means you're going to generate pay stubs for them, pay some of their payroll tax. All of that data will get reported on your payroll tax returns. So really you'd have to consider, John, with your family members, are they considered true employees? Like what services are they providing for your business? Can you document a true business purpose? And then if you're paying them on payroll, it would be a wage deduction for you. If you're just giving them cash, like for a certain project, that would be considered a contractor. And you may have to issue them a 1099. So depending on how you pay them, they're a true employee, like they're showing up 20 hours a week. They show up to an office versus project basis. They may be considered an employee or a contractor. In either case, they may have tax forms that you do have to file. Can you do an S Corp if it's an LLC partnership? Yes. An LLC partnership is an LLC with multiple owners. And then that LLC with multiple owners can elect to be taxed as S Corp. What happens if you also have a W-2 job and a single member LLC? So that's totally fine. A lot of people are concerned with having multiple activities on their personal tax return. It's totally fine. If you have a W-2 job that's high earning, maybe $100,000 of a wage is a threshold to consider. It can impact whether or not adding the S Corp election to your LLC is worth it. But what happens when you have both? That just means that you put a W-2 on your personal tax return, and you'll generate a Schedule C on your personal tax return to report the single member LLC activity. What also happens in this instance, if your single member LLC has a lot of earnings, you have to consider that you're not withholding, you're not paying tax throughout the year on that self-employed income. So if you have a salary job, a couple things you could do is one, increase your withholdings so that you can kind of like pay an extra to cover that single member LLC's income, or you can consider making estimated tax payments. So if you have both and you're not adjusting for tax payments throughout the year, you may get surprised with a higher tax bill. It's because your single member LLC didn't have a way to pay in throughout the year. You'd have to actively, increase withholdings or do estimates. Gustavo, if I have a W-2 job and work freelance part-time, my reasonable salary could be based on part-time job. Yes, so determining your reasonable salary is going to be not based on your W-2 job. It's going to be based on the self-employment freelance activity. And how do you arrive at that salary? Exactly like you said, you want to consider whether you're full-time or part-time, what's a comparable salary in your region, what's your seniority in this role, are you new and learning, or are you experienced? And that's how you can, document and arrive at a salary. Is it correct to say that most tax advantages for S Corp over LLC is the owner distribution portion of the income? If so, okay, so this person is asking, is the highest advantage of S Corp the ability to reduce the tax on the owner distribution, the remaining profit? If so, what's the income threshold where it doesn't make sense to maintain S Corp? So you can be an S Corp with any level of income. You can have a loss, you can have $10 million every year as an S Corp. The IRS doesn't care how much you make. If you're looking for a savings opportunity, what you have to consider is what I save going to be more than what I pay a CPA or collective to do all this extra compliance? So on the low end, that's why we mentioned that $60,000 threshold. Is because that's generally the point at which the savings potential is going to exceed the cost of a collective subscription. On the other end, you can make as much money as you want and still operate as an S Corp. S Corp is what's called a pass-through business, which means it doesn't pay business level tax, but you as the owner pay the tax. So if you're earning $1 million through your S Corp, it's not going to pay a corporate level tax. It's just going to flow through to you as an individual and be subject to your personal income tax rate. Sometimes if if you're a high earner, if your S Corp is making $1 million in profit, it could mean that your reasonable salary is higher, which means you're going to, pay the most in Social Security tax. There's still an opportunity to reduce Medicare. So it could mean that, maybe the savings potential is just a little bit less, but it still exists. Ted, I have a PLLC set up currently taxed as a C Corp. What is the deadline for 2025 to change the election from C Corp to S Corp? So the deadline for 2025 was March 17th of this year. It's 2.5 months from the desired effective date. But the IRS has a late relief process. So Ted, you can look into, it's called Form 2553. It's the normal S Corp election form. You would just apply for the S Corp election effective the start of the year, and you'd have to follow the late relief process. It's, there's directions on the bottom of the form. There's still time. So the deadline to do it timely was March 17th. If you do it after March 17th, you just have to request late relief. Does the S Corp have the same name protections of personal assets as the LLC? Yes, that's a great question. When you elect S Corp status, your legal entity that's underneath remains intact. So you would, if you have an LLC, you would exist as an LLC with the S Corp election. So you're actually both. So the liability protection, separation of business and personal assets still exists when you elect S Corp. For the 160 example, the savings example, how does one choose how much the salary should be? Why is it 60K? Can it be lower? Again, so determining the salary is very arbitrary. The IRS does not have a formula. If you do some Googling, you might see the 60/40 rule. It's not a vetted calculation by the IRS. It's just a general rule of thumb. What the IRS says in the tax code is it needs to be reasonable, and that's pretty much the extent of it. So how do we arrive there? It's similar to a question we had a little bit earlier. You want to consider, are you full-time, part-time, where you live, your seniority in the particular role. Collective members will help you decide on a range, what not to go below. So the risk in setting a low salary is that the IRS could reassess the salary for you. You can save more because that's less than Social Security and Medicare. But the flip side is if the IRS were to flag it and redetermine a salary for you, they would assess the Social Security and Medicare tax on that new salary, plus penalties and interest. So there's a risk in setting it too low, but not, so low that you flag the IRS, not so high that you forfeit self-employment tax savings. If you're looking to determine a salary, I would just document how you've arrived at it and just put it in like your, business folder on your desktop. Salary is fluid also. So you have the ability to skip payrolls. You'd adjust it year over year if you're, you stop working for 6 months or you grow exponentially. You want to adjust that salary annually. Kate, what a timely question. Doesn't there need to be a 60/40 split between salary and distribution? Yeah, this is a general rule of thumb. So this is not an IRS vetted formula. 60/40 is just something that's easy for people to follow. The way you arrive at this salary is very unique to your facts and circumstances. So again, where you live, how much time, your seniority in the role should be considered. So are you saying that if you are in an LLC, you pay 2 taxes, self-employment tax and income tax on all profit? Yes. If you are an LLC or sole proprietor or even S Corp, you always pay these 2 taxes. It's just how much of it do you pay? So you pay income tax on your entire profit always. It could be federal and state depending on where you live. And then if you're an S Corp, you'll only pay the self-employment tax on the salary. Tasia, yes, this will be emailed to you. Kimberly, what percentage of your total income would you have to pay yourself? So again, it's not, there's no percentage, there's no rule, very facts and circumstances based for determining your salary. Oh, this is a great question. Jamia, can you deduct owner's distributions as business expenses? No. So you've got your revenue, what you bill your clients minus deductions. Deductions are anything that's ordinary and necessary to generate revenue. So this could be your home office, mileage, marketing, collective subscription. What else do people pay for? All of those are eligible business deductions that help you arrive at profit. So you want to capture as many deductions as you can to make profit as low as possible because the profit is what you're taxed on. From there, the profit is what you can distribute out to you as the owner to use personally, and it'll be either in a wage or a distribution. And if you're an S Corp, it'll be both. But owner distributions are money that it's profits given out to the owner to use personally. So if you're using something as a business expense, it's not going to be considered a distribution. It's going to be a write-off that helps you get to profit. So how does paying lower Social Security tax affect what you get monthly when you retire and start to collect? We've got a great resource on this. I am terrible at explaining. The IRS basically has like a lifetime credit threshold to determine eligibility. And then the amount you contribute can impact your payout in the future. I'm going to defer to the article that we can send in the post-webinar email. I need to work on my explanation of this. There will be an impact It's a little bit of a trade-off. What's the balance between, seeing tax savings now versus will there be Social Security tax? I think that idea has floated around for a long time. There is an impact. Let me make sure that we get you a resource to address that in more detail. Does an S Corp have to make quarterly estimates to the IRS as well? So again, the S Corp is pass-through, which means it doesn't pay a business level tax, but it flows through to the owner. So really quarterly estimated tax payments, if you have an S Corp, you're still making quarterly estimated tax payments at the individual level because quarterly estimates are supposed to be prepayments into your total tax bill. So you don't want to factor just your S Corp income if your spouse works, if you've got a couple rental properties, some investments on Robinhood, all of those get factored into your total tax bill. And that's what quarterly estimates prepay into. Some states have a state level S Corp tax. And so if you live in one of those states that assesses an S Corp level state tax, then you may have to do quarterly estimates for those, but you never have to make quarterly estimates to the IRS at the federal level when you have an S Corp. Those are done at the individual level. Tasia, does liability remain the same as an LLC? Again, yes, the LLC still exists underneath your S Corp election, so you are both at the same time. So the liability protection, carries through with your S Corp election. Jessica, can we deduct mileage and gas? If not, which one do you recommend we track to deduct? This is so taxy. There are two ways that the IRS lets you deduct vehicle expenses. One is a very simple method. You take your total business mileage and you multiply it by an IRS determined mileage rate, and that becomes what you can deduct. Super simple. It's called the standard method, is taking, the mileage rate. Simple math, you just track your total mileage. Alternatively, there's another method called the actual method, where it allows you to depreciate your vehicle. It allows you to deduct gas, tolls, repairs, maintenance, anything like that. So it's taking actual deductions versus just applying a mileage rate. If you're considering the actual method, you want to consider, like, is this a full-time business vehicle, or am I using it mostly for personal and sometimes business? That can factor into which option you use. Collective members will most often choose mileage because it's so simple. How is the owner wage distribution information known to the IRS? I'm going to say that one more time. How is this owner wage / distribution information known to the IRS? So how does it get reported? Two parts. One, when you elect S Corp status, you trigger a need to file an annual S Corp tax return. It's called Form 1120S. It's due every March. And when you file that business tax return, there's going to be a form called a Schedule K1. And a K1 is generated for every owner of the S Corp. The K1 will show, like the rest of your remaining business profit. That's how the IRS, that's the form you include in your personal tax return to show your remaining business profit that you would pay tax on. It'll also show your distributions. So the K1 and the S Corp tax return are filed with the IRS. So that's how the IRS is informed. Then out of your S Corp, you're also paying yourself a reasonable salary. And at year end, every January, all the payroll tax returns are due. And you'll get a W-2 from your own business, which will also be included in your personal return. When you file a W-2, it also gets a copy gets reported to the IRS. That's all part of the payroll annual reporting process that's done through a payroll software. So filing the S Corp tax return and filing a payroll tax return is how the IRS is informed that this income was generated through an S Corp. Then what the IRS expects as you as the owner is that you include both the K1 and your W-2 on your personal tax return. So if you have a K1 and you don't include it in your personal filing, it's going to flag the IRS that there's missing, income or a loss, and you may have to amend your personal return. We are at time. There's a lot more questions, so I'm gonna go for a little bit longer. If we didn't get to your question, we will skim through it, and we can figure out a way to address and get your answers to you. I am a sole proprietor and I heard that my business has to make more than 60,000 a year to make an S Corp. Is this correct? So again, there's no rule with the IRS to make the S Corp election. You can do it now if you want to, but if you're looking for a savings opportunity, that's where you may pause at maybe the LLC stage and consider S Corp status at a later date. If you did it below 60,000 of profit, so after your write-offs, what it might mean is that you would pay more for either collective or a CPA and a bookkeeper. You may pay for those services more than what you can save. Keisha, which way is best to pay myself a salary, by distribution or a W-2? Depends on how you're structured. So if you're a sole proprietor, nothing's formed, or you're a single owned LLC, what it means is you report on your personal tax return. And if you report on your personal tax return, you don't run a formal payroll for yourself. If you're reporting on Schedule C, it's distribution only, which means you just take cash out of that business bank account and use it for your personal expenses. Or if it's all combined into one bank account, you just use it. Those are not considered deductions. Those are considered distributions. If you are an S Corp, you're required to do the salary component. So you run a formal payroll, which means you'd get a W-2. And then you can distribute more cash out of the profit to yourself. So it could be both under the S Corp. I'm going to go for 3 more minutes if you guys are good to hang on. We've got 126 people still live with us. Thank you. Edwin, do I pay estimated taxes as a personal filing with an S Corp? Yes. So again, estimated taxes are a prepayment into your personal tax bill in this instance. Because S Corp flows through to the owner level, it doesn't pay a federal corporate level tax. You would pay quarterly estimates at the individual level under your Social Security number. And you want to factor in all your other income sources. So partner working, investment income, rental properties, all of that should be factored in when you're determining your estimated tax payments. Gustavo, if I go with an S Corp right now, would apply for the whole 2025, how would the salary missed for the first 3 months of the year be accounted for? So the first part of the question, if you applied for the S Corp right now, would it be effective for all of 2025? It depends on if your legal structure, so LLC, was in place already. If the LLC was formed in 2024, then you can have a clean January 1st S Corp effective date if you make the election following the late relief process. If you don't have an LLC or a legal structure yet, and you're looking like the profit's going to be high, you're not earning a lot on your salaried role, you would want to set up an LLC as soon as possible because that's the earliest you can elect S Corp status. And then if so, how would the salary missed for the first 3 months be accounted for? You have the option to run a retroactive payroll. So if you were to join collective or you were to, DIY payroll yourself, once you're set up on the payroll software, you can do like a one-off payroll and just do some kind of catch up. Some people opt for this, some don't. You could do a bonus at year end to get it closer. You can run an off-cycle payroll later in the year. There's a lot of flexibility in the timing of payroll. What you want to consider is like the total activity that's reporting, and will your year-end salary still be considered reasonable for the activity that gets reported on the S Corp return? Okay, Nikhil has an LLC turning profit for the first time this year. As of today, I'm not paying myself anything and don't anticipate to for another 2 years. Does it make sense for me to move to an S Corp if I'm not planning to withdraw? So you only have, I've not said this yet, you only have to pay yourself a salary if you're going to also take distributions out of your business. If you're not taking money out of your business, when would this make sense? Like if you have a full-time salaried role and your side hustle is just extra income, you don't need to withdraw. The advantage could be if you elect S Corp status and don't take a salary and don't take distributions, there could be an opportunity to reduce the self-employment tax. If you were to stay in LLC, that entire profit, whether you distribute it out or not, would be subject to the self-employment tax. So if you're not planning to take any distributions, it is acceptable to have an S Corp without taking a reasonable salary. I'm going to do one more. Sabina, I'm going to stop at your question. Is it true that if your income is less than 60,000, S Corp won't make sense for you? Again, this is not a rule with the IRS and how much you have to make to be an S Corp. It has to do more with what are you looking to gain? Do you want to gain tax savings, or are you trying to punt all this admin work? If you're looking for savings and you're earning less than 60,000 of profit, you may pay more for compliance. So bookkeeping, payroll, separate business tax filing. You may pay more for all of that than what you can save on self-employment tax. And so if savings is your goal, it may not make sense if you're around that 60,000 threshold. If you're just looking to get this back office work off of your plate, growth is coming and you don't want to have to think about it when that happens. Like, there's nothing stopping you with the IRS from becoming an S Corp now. We are 7 minutes over, so I think we're going to call it there. I think I only got through half of the questions. I really appreciate your participation. We will do our best to get you answers, resources on the impact of Social Security tax on your future payouts. Thank you so much. I know the participation is, hit or miss sometimes, and there's so many questions, so much engagement. Keep an eye out for the email that will come out with the recording and additional resources. And again, if you're interested in a follow-up call, scan this QR code, 1 month free with Collective. If it makes sense for you, it'll be available till the end of the week. And thanks for joining. Take care.